everyone. Welcome to Inside the Deal, Healthcare VCs to Watch. I'm Carrie Nixon, and I'm the founder and managing partner at Nixon Law Group, where we work with healthcare innovators who are building the future of care. So the purpose of this series is really to spotlight investors who are both backing great health tech companies and who are helping founders to navigate the complexities of scaling in healthcare. Several of them were recommended by clients of ours as really good partners for companies who are looking to grow and to scale. And so today I'm joined by Parth Desai of Flare Capital. So for those of you who may not know, Flare Capital is one of the largest, if not the largest, a VC fund that's focused entirely on health tech. So I know Parth is going to have some great insights to share with us, and I'll want to get rolling. Parth, thank you so much for being with us today.
Yeah, of course. Happy to do it.
All right, so I always like to sort of start out with a very easy question about what first drew you to healthcare. Did you get involved with healthcare when you started as an investor, or does your involvement with healthcare sort of predate that?
Yeah, it's a good question. So, my introduction to healthcare really started off kind of when I was younger. So, I come from a family of clinicians. My parents are both clinicians, and my broader family, many clinicians, across the family. And so, in some ways, like the pathway to get into healthcare was almost preordained for me. The question for me, though, was kind of which area of healthcare I wanted to go into. And so, I think initially, when I kind of started off thinking through what this looked like and going from high school to college, pre med was the natural starting point. I actually did that, went all the way through that, applied to medical school, started at BU School of Medicine, and did a couple of years there. And I actually took some coursework in the public health ecosystem, and that's where I got a little bit more exposure to what other parts of the healthcare ecosystem look like. Long story short, a couple of different experiences there kind of opened up my aperture and exposure to the policy side of things, the business side of things, ultimately led me to kind of where I'm at today.
Yeah, so this clinical side, the policy side, even some management consulting. How did that sort of varied background shape your investing perspective?
Yeah, so healthcare is interesting. Unlike many sectors of the U.S. economy, healthcare is shaped in a couple of different ways. There's obviously the clinical innovation that drives a lot of the core therapies and care protocols and procedures that are a normal part of day-to-day care. But the interesting thing about healthcare is how all that innovation infuses through the ecosystem and how it's paid for is shaped so heavily by policy and the regulatory ecosystem. Obviously, again, unlike many other parts of the economy, but also unlike other countries, a good chunk of that payment is coming from the government. And so understanding how policy is evolving and how regulatory policies and influencing both what types of care infuse through the ecosystem, but get embraced and get adopted is so important. So, having that policy angle to me was initially super important, and it plays a big role in how we do our job. I feel as if we're not effective in doing our job if we don't know what's going on in Capitol Hill, or we don't understand, what's going on at the state level, what budgets look like at any given time, how new innovation policy is shaping what may or may not be investable moving forward. So that's one part of it. And then there's obviously the business of healthcare, right? It's tying that reimbursement through to the innovations coming out to market, and then figuring out, what's appropriate to invest in, to deliver, how you structure the models to deliver that care and make sure that care gets in the hands of patients. And so, part of the experience for me, management consulting, but then I was at a large health system called New York Presbyterian Hospital for a few years, understanding, how that system operated, how they thought about strategic innovation, and the business of healthcare was super helpful. And that's a core part of our job today, right? To understand that, to spend time with the leaders of these organizations to see, how they're making different budgeting decisions and investment priorities, because that shapes a lot of kind of where we invest. If you think about it as a VC, we're investing in very early stage innovation. Sometimes the things we're investing in are ideas on paper, and the bets we're making are that reimbursement policy is going to evolve in such a way that will be favorable to this product that we're investing in, but also that eventually budgets will emerge to pay for the products that we're investing in. And so we're constantly in the business of like timing the market. Oh, typically we're investing on I'd call it like a 5 to 10 year time frame. So maybe sometimes a little bit earlier to a market, but the hope being that, over that 5 to 10 year period, the market embraces that product at a high velocity. And so again, we're calibrating all these different factors and patterns, and I'm drawing upon all these different experiences in my background, to make sure that we're timing things appropriately and we're underwriting risk appropriately, when we're making these investments.
Right. And what size checks are you generally working with when you're investing in a company?
Yeah, so it depends. I would say typically our first check sizes range anywhere from, two, give or take 10 million. There's a little bit of flexibility here or there, but that's usually the size of our first check. And then, we're partnered with companies through the entirety of their journey. So then we set some capital aside, anticipating that, over the journey of the company's trajectory, they'll need to raise more capital, and we'll want to be capital partners at each step of that journey.
So when I first introduced you, I mentioned that Flare Capital is one of the largest VC funds focused entirely on health tech. So I am wondering about your insights on what founders should be thinking about when they are looking at a large fund, right, like Flare, versus a much smaller fund. What considerations should they have in mind?
Yeah, so the entire funding landscape is super vast and super broad, right? Like when you're starting a company, you have many options in front of you. You can decide that you want to take a little bit of capital. You want to put some personal capital in. You want to take some capital from angels, individuals, and raise a small amount. And maybe you want to build a business that doesn't raise a whole lot more capital than that and is really self-sufficient. Gets to a point where it's fully bootstrapped and then profitable. And then you may never need to raise any more money. You just want to manage it to a steady rate of growth. That option's there for you. You may decide that you want to at some point take that profitable company and really pursue a big opportunity. Maybe you want to raise capital to do some acquisitions, or you want to go after a higher rate of growth. At that point in time, you may decide, if your business is profitable, that private equity is the right answer for you. Venture capital is a form of private equity. And then within venture capital, there are many different kind of funds and fund styles and stages that different funds play at. On the earlier side of things, you'd have what I'd call pre-seed and seed stage funds. Those are funds that specialize in kind of being the first check into your companies. They typically will write their largest check at that period of time and then have kind of dwindling reserves. Not everybody, but most will have dwindling reserves. And their role is to help you find product market fit. They might have a lot of conviction in a team and an idea, and they're spending all their time making sure that that idea finds a market to embrace it. And then, they'll hand it off to what I would call a group of firms that specialize in accelerating that product market fit. I would describe Flare as a full life cycle investor. So, we will write our first check anywhere from seed, Series A to Series B most often, but we have flexibility to go at any stage. But what we specialize in really, if you take a step back, is we're a healthcare specific fund. Seed, Series A, and Series B tends to be our sweet spot. And 60% of the roughly $1 billion or so in capital that we manage comes from about 19 hospitals, 12 health plans, and 9 life sciences companies. Those folks have, I think these numbers are directionally correct, have contributed about $940 million of revenue to our companies as customers They've co-invested, I think, about $220 million with us. We've incubated 7 companies with them. So those relationships play a really important role in shepherding the growth of our portfolio companies. And given where we play, what we tend to specialize in and how founders should tend to think of us, but also there are, a handful of other firms that operate in a similar fashion to us is really in that kind of launch phase, finding product market fit, all the way through to accelerating product market fit. And that's our area of specialty, and that's where to think about us. So you could have an idea, and you need help getting that idea off the ground, recruiting a team. We will incubate companies from the ground up, just with protocols and IP, all the way through to taking a company that has found some initial product market fit, has a few customers, but really wants to put their foot on the gas and accelerate that. And that's where our healthcare relationships play a really important role in fueling that growth and helping that company kind of get to a level of growth where they can then go on and raise growth capital. Maybe the next capital that they raise is capital that is part of a transaction. But again, that's kind of where we fit into things.
Yeah, I mean, those numbers that you put out about health systems and their involvement in the fund and your portfolio companies, super interesting. Um, so strategic investors like the health system venture arms that you mentioned clearly play a big role in with Flair. And so, how do you think about balancing sort of the health system's interests, given that they are investors in the fund, with the companies that you may invest in?
Yeah. So two different things. One is our LPs can be health systems. We have, again, roughly 19 health system partners of ours. Not every one of those health systems, though, partners with us in our portfolio companies from a dedicated corporate venture arm. Some, some operate our relationship with them from their treasury function, and then we work with their innovation or corp dev or other operating leadership teams to shepherd the growth of our portfolio companies. Other of our health system partners fit the profile of what I call like a traditional corporate venture group. So, they will have a dedicated venture investment vehicle, and they will co-invest alongside us in addition to helping to, steer that portfolio company through the right commercial leadership in their organization. Typically I'd say we're very aligned. We like to, when we invest, we really like to then, talk to our LPs and our strategic partners about the investment we're making, because it's a really big part of our diligence process. It's a really powerful signal when you find something, let's say you find a technology solution that you're really excited about, that you think will transform a segment of like the hospital system enterprise. It's a really powerful signal when you show it to your 19 health system partners, and many of them say, hey, this truly actually is exciting. And not only does our commercial leadership find it exciting, but we want to make an investment to double down on that enthusiasm. So many of our partners will do that, right? They will both become a customer of the company, but they might have a co-development effort underway where we're working with early stage companies. There may be new products or modules that a specific health system might be very well equipped to help that company develop, and they'll be excited to invest the time and resources to do that. But the venture function kind of aligns incentives in that, they'll write a, let's say, couple $1 million check in addition to their commercial relationship, and they'll view that investment as kind of the upside reward for the time they're investing in helping to co-develop that product, or helping that company kind of work through different opportunities or challenges. And so, those incentives tend to typically align pretty well. And we find that to be an additive accelerator of the company's commercial progress, in addition to being a strong signal.
I mean, what a vote of confidence for the companies, right? To know that multiple, strategic investors, like health systems, think this is a good idea. This is going to work, and it's such a good idea that we're willing to invest alongside. That's a pretty big deal.
Yeah.
So, how does your investment team, obviously you're not just you on your own, floating out there. How does your team think about assessing a deal? I'm sure as you're evaluating, sometimes there's difference of opinions, right, amongst the team. How do you kind of think about that and come to consensus?
Yeah, I would say it's a very natural part of any investment process, no matter which fund you talk to, for there to be disagreement. I think that's when we make the best investment decisions. There are many old adages that I've heard from other venture funds where like their best investments were the ones where one person pounded the table and laid down on the train tracks to make that investment, and everybody else was, vehemently against it, and that ended up yielding an outsized return. And so I think our partnership generally looks for what I would call like a deal team, the sponsor of the investment opportunity, to have a lot of conviction. And part of having that conviction is defending areas where that deal team might have a unique knowledge or perspective or enthusiasm about a specific product or a company that the rest of the partnership might not share. And it's normal, it's natural, it's encouraged for people to dissent, because that helps us make better investment decisions. Some of the places that often shows up and where we have maybe differences in opinions oftentimes is in, I talked about the notion of, we're in the business of in some ways timing the market, making investments in companies that have captured a unique window of time to sustain, really high velocity growth and create a lot of value at a high velocity in the healthcare ecosystem. And there's often a debate on, whether we're timing the market correctly. You know, uh, my colleagues will bring in things that I think we can all generally agree are super innovative, super transformative. And we're often asking, hey, are hospital systems ready to actually buy this technology? Do they have budget for it? Are health plans ready to buy this? Do they want to build it themselves before they try and go and buy it? And, is this something that's offered by, their existing vendor partners? And, what's so novel about this that they need to buy it today? And that's where we often have a lot of dissent. And I think what's really helpful is, again, when we can get on the phone and have these companies pitch their products to a lot of our healthcare partners and hear firsthand, how those commercial executives view that. Some of our best investments actually have been in companies where you'll take an early stage product and you'll introduce that founder to 5, let's say, different health systems, and all those health systems or health plans or pharma companies will kind of bring executive leadership teams who have seen very similar solution sets. And some of our best investments have been the ones where independently of one another, these commercial leaders have given very similar positive feedback, saying like, hey, we've seen a lot of these products, this is unique for reasons X, Y, and Z. And when we tend to see that, tend to see a diversity of groups who provide similar positive enthusiasm or feedback on a product, we typically view that as a very strong signal that this could be, a good investment. And when we see divergence in that, that can be another signal for us. But that's where we're typically, having, I would say the majority of our debates is like, is now the right time? How big do budgets look? Are those budgets going to grow? What is going to accelerate the need for these enterprises to buy these products or shrink that? And what's that window of time, right? Anyways, that's probably the most common area.
Yeah, so dissent is not always a bad thing for sure. So I often hear investors talk about whether a company is venture ready or venture backable. What would you say to founders that those terms mean to you, and how might you sort of apply them?
Yeah, and again, it's a lot of the same things that I was alluding to earlier. I think when we talk about venture backable, I think a couple things need to be true. One is, um, there are many companies out there. I would say, the vast majority of the cohort of publicly traded companies, they're very strong, stable, predictable companies. They grow at a rate that's pretty, I would say, within a pretty tight band. There are obviously some outliers, but 10, 20, 30% year over year on the top end. And those actually happen to be very good companies for another segment of the private equity market to also target, profitable, steady growing, predictable, and maybe there's a few things you can do to kind of yield faster growth or create, expanded value in that product. When we talk about venture, what we're talking about are companies that can grow at much higher rates, meaning the founding team is very motivated by the concept of achieving fast growth, and the product itself has the potential to unlock that rapid growth. And when I say that, I mean, I'm talking growth rates that are on the order of 100 all the way to, or we've seen some companies that have grown 500, 600%, 700% year over year, like on the top end. And when we're talking about venture backball, we're talking about companies and teams that have the potential to sustain that rate of growth for multiple years at a time. So that's uniquely what's distinct about venture. When we're investing, we're typically not focused on things like, instant profitability. We're focused on investing and guiding companies in unlocking that rate of growth, because there comes a time where it makes sense to start to focus on profitability. But typically, again, that's not when you're going to a venture capital fund and looking for, their support and guidance and again, capital.
Yeah. No, that makes sense. So shooting off in another direction, I'm interested to hear. You obviously have your fingers on the pulse of health tech, and I am wondering if there's sort of a commonly hyped health tech innovation out there that's really buzzing now that you actually have some healthy skepticism about, and why?
Yeah, it's a really good question. Look, I think I'm of the mindset that there is a lot of great healthcare innovation out there. I mean, every product that's out there that's scaling, that's raising capital, is doing so because they've convinced a segment of very astute commercial leaders and investors that their product has very high growth potential and transformation potential for healthcare. It's a breakthrough technology. I think the trap we sometimes run into as investors is when there is what I would call a race to fund the best companies in the category, almost what I would call FOMO.
Mm.
And we can run in this trap where we overcapitalize a company and overvalue a company or a segment, a category of companies, and inadvertently create pressure to grow that the company is going to have a very hard time to sustain. History has told us that we can get ahead of ourselves sometimes as investors. There's a long tail of companies that, I don't have to go into kind of naming all those companies, but long tail of companies that have kind of run into this trap. And this happened very frequently in 2020, 2021.
Yeah.
Um, and, those companies ended up failing, not because they weren't good products or good companies, but again, because there was just the pressure to grow and the valuations they were given were just too lofty for them to fill in. And I think I think, many of us in the ecosystem would argue that there are probably, and again, time will tell how this plays out, but there are probably categories of healthcare where there is an enormous amount of capital going in and really high valuations that are probably hard to underwrite against if you look at the typical comparables like publicly traded companies or, precedent M&A transactions. But I think like what the investors in those companies that are giving them that valuation and those capitals will argue is like this is a fundamentally new category. They're going to open up segments in the market that didn't exist before, and so that valuation is justified. And you can't get all the way there if you just look at comparables. A good example of where this debate's happening right now is probably in the AI scribing market.
Yeah.
And that is the most classic example, right? There are several companies that, depending on how you slice the TAM, there are several companies where you could argue that, their valuations are probably greater than the total addressable market, that they're tackling. But I think, what the investors in those companies will tell you and what the companies themselves will tell you is, well, we're not stopping here. We're not just a scribing solution. There are additional segments of the market and additional product opportunities that we will start to tap into over time. And what's really fascinating is if you talk to the buyers of those technology solutions, some of them will also tell you that, hey, my budget went from $1 to $5 million year over year, almost overnight, because my expectation is this is not just going to be our scribing solution. It's not just going to replace, our dictation products and create a better physician experience of care. In fact, I expect that this is going to become our billing and coding solution. And I budgeted for as such, expecting that, I will stop spending as much on the dedicated billing and coding solutions I have and divert it to the Scribe once the scribing solution will own that functionality. I think we can debate all day whether, that is a realistic expectation. Companies are typically raising on 18 to 24-month windows. And so the question you really have to, I guess, wonder is like, will the capital they've raised and the valuation they've raised is that enough time for them to launch enough products and unlock new revenue streams that can justify that growth, or not? And again, the time will tell. I think what's very clear to us is like this technology cycle we're in is a fundamentally different platform shift than anything we've ever seen before. And what we can build and achieve in those periods of time are much different. But, there's probably a big spotlight on, that category of company right now.
For sure. Yeah, no, I totally agree with you. 2021, 2022, I think almost digital health as a whole became overhyped, right? And everyone had FOMO. And so you had investors who frankly were not familiar with health tech plowing a bunch of money in maybe not super smart ways. And that we didn't have a good result there. But and AI is, AI I think is the prime example here. So much activity in the space. I'm pretty optimistic about it in general. The AI's ability to sort of really make a difference in healthcare. I'm very optimistic about that. But I hear you on the pressures, that those companies will face. That's real. That's real.
And I think to your point, which is a really important one, I don't want to miss it. There's a reason why all this capital is flowing into the category. The growth rates of I would say there probably, in our view, there's 6 or 7 categories of healthcare that are capturing the vast majority of AI budgets today. That's the scribes, but it's also coding and billing solutions. It's what I call care management, utilization management solutions, imaging and diagnostic solutions. There's some categories of pharma as well. But, there's probably a distinct subset that are capturing the vast majority of budgets today. Like leading companies in those categories are growing at probably top end growth rates 500, 600% year over year. The top quartile of growth for healthcare software companies over the last decade has been about 150%. So the point is that these companies are just fundamentally growing faster than any previous wave of technological innovation we've seen before. And they're showing real value. One of our investments, a company called Smarter DX, went from zero revenue, zero customers in 2022 to a little over 100 million in contracted revenue this year. And they just, had a big transaction, but that was predicated on the fact that they were creating value and ROI far above and beyond what all the other technological solutions their customers had installed and put in place ahead of their product had created before. And that's why budgets have opened up to sustain that. And so it's an example of the fact that, these companies are growing, but they're growing for a reason. Budgets are available and they're showing the value that you need to show to rationalize those budgets. And that's different. And it's happening at a different scale than, what we've seen in the past.
Yeah, I'm super excited about it. I really am. And I know you are too. I promised that I was going to keep you on schedule, and so I want to thank you very, very much for joining us and sharing so much of your insight. From years of experience and from probably thousands of companies that you've looked at this point. So, thank you very much for that. And I will say to our audience, I'll remind them that at Nixon Law Group, we have spent the last lot of years ourselves working with founders at all stages as they grow and as they scale. And if you'd like some of the resources that we have to support a company's journey along the way, please take a look at our website or follow me on LinkedIn. So I'll also invite founders to follow us for more conversations with VCs that are shaping the future of healthcare. So thank you so much for tuning in to Inside the Deal, Healthcare VCs to Watch. And Parth, thank you again.
Of course. Thanks.
Till next time.